Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at New Era Energy and Digital.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our analysis. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
We are starting today with a company that has gone through a transformation so radical, it's like it fundamentally changed its own DNA. We are talking about New Era Energy and Digital, a company that was, just recently focused on helium.
Right, and now they've executed this massive strategic pivot. They rebranded fully in 2025 to chase really just one thing.
And what's that?
Building the essential energy-integrated infrastructure for the entire AI revolution.
So that pivot is really the key here. This isn't just, adding a new division or something.
No, this is throwing out the old strategy entirely.
Yeah.
They are completely laser-focused on what a lot of analysts call the picks and shovels approach to AI.
The picks and shovels, meaning forget the flashy software and chip design.
Yeah, exactly. Focus instead on the concrete, the land, the raw power that you need to actually run those massive GPU clusters.
And when we talk about ambition, the scale here is it's staggering. They aren't chasing marginal growth.
Not at all. They're chasing gigawatt scale. And they have two massive projects underway that really form the core of this whole narrative.
Okay, so let's start with the first one.
The near-term focus, and really the heart of the story right now, is the Texas Critical Data Centers, or TCDC. That's their joint venture with Sharon AI.
And they just expanded that, didn't they?
They did. They just secured another 203 acres, which brings the total campus size now to 438 contiguous acres.
Wow. 438 acres just for high-density compute power.
And this campus is engineered to scale beyond 1 gigawatt of capacity.
Can you put that in perspective for us? 1 gigawatt.
Well, think about it like this. A standard hyperscale data center, a big one, might run at, say, 50 to 100 megawatts. Okay. New Era is planning for 10 times that on one single site.
That is an enormous undertaking.
Yeah.
And the timeline sounds really aggressive.
It is. They've already completed the Phase 1 engineering, and Phase 2 is well underway. They're targeting initial power delivery for early 2027.
But what makes this Texas project truly competitive? The market is starved for power.
That's the thing. It's their strategic power solution. This is where we get into the behind-the-meter strategy, the BTM.
Located in the Permian Basin. And this isn't just some, clever accounting trick. This is their core structural advantage.
It is. So why does BTM matter so much right now in the AI world?
Well, because getting power is the single biggest bottleneck for deploying AI, isn't it?
It is the bottleneck. If you try to connect a multi-hundred megawatt load to the traditional utility grid, you're looking at 5, 7, maybe even 10 years in interconnection queues.
10 years, you miss the whole wave.
You miss everything. The BTM strategy bypasses all of that.
So they are essentially co-locating their data center.
Right next to it.
Right next to its dedicated natural gas power source.
Precisely. They cut the utility middleman right out of the deployment timeline, and this gives them two massive advantages.
Which are?
Much shorter timelines for getting capacity online, which is critical in this hyper-competitive AI race, and it locks in lower, more predictable energy costs.
Turning a huge expense into an efficiency.
Exactly.
So if Texas is the immediate bull case, what about the New Mexico project? That seems like the really long-term vision.
It is. That plan is built on 3,500 acres, and it's aiming for an almost unbelievable 7 gigawatts of total capacity.
7 gigawatts.
And that capacity is divided into two phases. You have about 2 gigawatts of initial natural gas power, followed by a planned 5+ gigawatts of future nuclear capacity.
Using modular reactors.
Using modular reactors. So if they execute on this, that positions New Era Energy and Digital as a massive multi-site energy platform. They could eventually rival the generating power of a regional utility.
And we should probably acknowledge the macro tailwinds here, too.
Yeah.
This isn't just some random corporate strategy happening in a vacuum.
Not at all. It's being validated at the absolute highest levels. The U.S. government's recent Genesis mission executive order,
Right.
it essentially labels AI compute and its required energy infrastructure as a national strategic priority.
I remember that. They compared it to the Manhattan Project.
Yes, that policy narrative explicitly compares the urgency and scale to the Manhattan Project. That kind of high-level government validation, it lends incredible weight to New Era's story.
It means they're building exactly what the country needs right now.
Rapid energy integrated compute capacity.
Okay.
Yeah.
That is a really compelling vision. Immense scale, a clear structural advantage with BTM, major government tailwinds. It's easy to get excited.
It is.
But
Yeah.
as we always must, we have to transition now to the present financial reality.
And this is where the story gets acutely challenging. When you talk about building multi-gigawatt projects, you are talking about capital expenditures measured in the billions of dollars, and that runs headlong into the company's microcap market value.
Let me stop you right there, because this disconnect is the absolute core of the risk, isn't it?
It is.
Analysts estimate that building just one of these 1-gigawatt facilities can cost, easily $5 to $7 billion for the initial build-out?
That's a conservative estimate, yeah.
So let's do the basic math for you listening. This company's current market valuation is sitting around the high $200 million mark.
Right.
They need at least 20 times their entire market value just to complete their first Texas facility, let alone the 7-gigawatt New Mexico campus. That isn't just a financing problem. That's an existential gap that has to be bridged.
And that gap is reflected clearly in their latest financial reports. They show the extreme costs of trying to scale an operation this quickly.
So what are the numbers?
The company reported an operating loss of over $4.2 million for Q3 2025 alone.
For 1 quarter.
For 1 quarter. And when you zoom out, the operating loss for the 9-month period is over $8.1 million.
That kind of burn rate puts an immense strain on their balance sheet. And that pressure led to, really, the most critical warning sign for any potential investor.
It's a liquidity concern.
Yes. In September 2025, management was required to issue a formal going concern warning.
Can you break down what going concern actually means for a company like this, for listeners who aren't, knee-deep in financial filings?
Sure. It's a very, very serious red flag. It means that the company's own auditors, or management itself, has substantial doubt about their ability to continue operations.
To pay their bills.
To pay their bills, meet their obligations over the next 12 months without securing a significant external capital infusion.
So they're essentially warning that if they don't raise money, they might not be solvent within a year.
That's it. And when you look at their cash position, that warning makes total sense. They are running on a very thin lifeline with a cash balance hovering around $14.2 million.
Burning through cash to chase a multi-billion-dollar dream.
And we see the immediate, painful consequence of this financial distress in their cost of capital.
A promissory note.
They just secured a promissory note for $4 million. The interest rate on that capital is staggering.
What was that rate again?
18%.
Annually.
18%. That is
right.
That is not institutional corporate financing. That sounds like bridging capital from a distressed lender.
It does. What does that interest rate tell us about how the market views New Era's execution risk?
Well, it tells us 2 things very clearly. First, the company had an immediate critical need for cash, and they prioritized speed over cost. They couldn't wait.
Right.
Second, the lender views the execution risk as extremely high. They're requiring a massive premium to take the chance that New Era will actually deliver and repay that debt.
So they're essentially saying, you might change the world, but your current balance sheet shows a huge risk of default.
Precisely. And that signal of high risk translates directly into the primary risk for current shareholders.
Massive dilution. It's the elephant in the room. Now, we should note one positive thing here.
Okay.
They did recently terminate an equity purchase facility, and they withdrew a proposal to increase authorized shares. And that was a very strong positive signal.
A nod to trust to protecting shareholder value.
Exactly. But the fact remains, the only way to fund a multi-billion-dollar project with a microcap valuation is through some form of massive capital raise. And that money is not cheap.
So until they secure that long-term institutional project financing,
the risk of significant future dilution just remains very high.
And that structural tension, the toxic fundamentals versus the massive vision, is why some quantitative models still flag the stock with the lowest possible scores.
Yes. The execution risk is tied directly to the financing risk. It's really an all-or-nothing bet right now.
Okay, let's shift gears and look at the market mechanics. The immediate flashpoints the traders are watching. This is an incredibly volatile stock.
Oh, it certainly is. The beta sits around 1.20, which is high. It tends to amplify market swings. You're looking at average weekly price volatility of over 15%.
So it's a high-risk proposition for anyone engaging with it.
A very high-risk proposition.
Despite all the financial headwinds, though, the stock has shown some pretty strong technical momentum recently. suggesting a potential short-term bounce,
It has. The chart shows it finding a floor right around the 50-day moving average.
which is a key technical indicator for momentum traders. It's sitting at about, what, 367?
Approximately $3.67, yes. And indicators like the stochastic oscillator were recently deeply oversold.
Meaning the stock was technically undervalued in the short term, poised for a potential move higher.
That's the technical read, yeah.
So for traders who are playing this volatility, what are the key levels they need to be watching?
Risk management is paramount. A hard stop loss is critical. You place it just below that 50 moving average floor, maybe around 365.
And on the upside,
If the technical bounce holds and the stock gathers momentum, the key profit target zone would be the R3 resistance level, which lines up around $5.70.
okay, now let's address the perennial retail trading fantasy, the short squeeze.
Hmm.
Short interest is high, which often gets retail investors excited. But is a squeeze actually realistic here?
We need to set expectations clearly on this one. Forget the squeeze fantasy.
Okay.
While short interest is definitely notable, the daily volume of the stock is massive, and this results in an incredibly low days to cover metric.
Can you break down what that metric days to cover really signifies for the average listener?
Absolutely. Days to cover tells you how many days of average trading volume it would take for all the current short positions to be covered or bought back.
And in this case?
In this case, the number is extremely low, just 0.07 days.
So what, all the shorts could cover in less than an hour of normal trading?
Well, under an hour. So there's way too much liquidity for shorts to get trapped. The price needs genuine buying demand driven by actual operational news.
Not some engineered short covering event.
Precisely. And while the short sellers are facing brutal costs, borrow fees are running over 88% annualized.
Wow.
That cost puts pressure on them, sure, but it's not enough to guarantee that kind of parabolic squeeze people dream about.
Okay, good to clarify. And before we get to the immediate catalysts, we should probably acknowledge one stabilization milestone they did achieve.
The Nasdaq compliance.
Right. In October, the company successfully regained Nasdaq compliance.
And that was necessary. Removing the delisting threat was an essential housekeeping item. It restored a necessary level of investor confidence, removed a major uncertainty.
Okay, so let's look ahead. The immediate future of this company really hinges on 4 critical flashpoints over the next 3 months. The first one is purely financial, and it's coming up in just a few days.
That's the $4 million 18% promissory note. It's due December 6th, 2025.
A moment of truth.
It really is.
Yeah.
How they handle that maturity, whether they repay it, secure a swift, lower-cost refinancing, or are forced to restructure, that will be the clearest and most immediate signal of their liquidity situation.
Flashpoint number 2 is all about the core business model. The market is buzzing about a potential anchor tenant announcement for the Texas campus.
Potentially in Q4.
Yeah, and securing an anchor tenant is the validation everyone is waiting for, isn't it?
It's everything. It validates the behind-the-meter strategy, it proves the campus is attractive to large operators, and it's the absolute prerequisite for securing future project financing.
It transitions the project from planned to operationally committed.
Exactly. Then you have partnership visibility. Flashpoint number 3 is the expected de-SPAC or IPO of their joint venture partner, Sharon AI.
Which is anticipated sometime between December 3rd and December 23rd.
And that event is going to put a massive spotlight on the Texas Critical Data Centers project because Sharon AI will absolutely use that campus to strengthen their own market narrative.
So New Era Energy and Digital benefits from that aligned visibility.
Significantly.
And finally, flashpoint number 4. Rolling into preliminary earnings season in January 2026, we need to look closely at the Q4 2025 report.
We do. Investors need to see tangible progress on operational efficiency, showing a path toward narrowing those operating losses, less negative cash flow.
It's essential to mitigate that going concern warning they issued back in September.
They have to prove they're managing the burn rate.
So to summarize the core conflict here, this is truly a race against time.
It is.
It pits a staggering, ambitious, and frankly, structurally brilliant future vision
Dominating the critical energy infrastructure space for AI.
against a very steep financial reality today, defined by massive losses and painfully expensive debt.
The company is burning millions to try and unlock billions. The investment question is fundamentally one of timing.
When will their scaling efforts finally hit critical mass?
Right. When do they secure that anchor tenant, generate positive cash flow, and solve the going concern problem, justifying the enormous risks and that 18% interest rate they're currently paying? The next few weeks are going to define the trajectory.
We will be tracking those four catalysts very closely. Make sure you subscribe to Smart Wealth with Joshua to follow these defining moments and all the upcoming flashpoints in the market.